Hello, how are you, people? Today, I want to talk to you about something that I find the most exciting and, at the same time, the most intimidating topic in the financial world: investments. You've probably heard that to invest, you need to be a millionaire, that it's a game for the rich, or that it's very complicated and risky. And the truth is that most of these are myths we've been told to keep us out of the game. The reality is that investments are the only way for your money to truly grow, and they are the path for you, me, and anyone to achieve financial freedom. In this video, I will not only give you a quick guide, I will provide a complete map, a step-by-step from scratch, so you understand everything you need to know about investments. I will explain the basics, the pillars, the types of investment, and finally, the mindset of a real investor. If you stay until the end, I promise you will understand why saving is not enough and why investing is the key to making your money work for you. Let's get started. 1. Why invest? The reality of inflation. Look, the first thing you need to understand is that your money, the one in your savings account, is losing value. Why? Because of inflation. Think of it this way. If today you buy a coffee that costs $2 and your country's inflation rate is 5% in a year, that same coffee will cost you $2.10. Your money, being idle, simply loses purchasing power over time. It's as if part of your money is evaporating without you noticing. Investments are your shield. They allow your money to grow at a rate faster than inflation, so instead of losing value, it gains value. It's the only way for your money to serve you in the future. Now, let's be clear, investing is not the same as gambling. Gambling is going to a casino or buying the trending cryptocurrency without knowing anything, expecting quick gains. Investing is buying a piece of a real company with a plan, a strategy, and a long-term vision. Remember this phrase: investment is a marathon, not a sprint. The best results are seen in the long term, with patience and consistency. El Mapa del Tesoro, the fundamental pillars of investment. Before you think about where to invest, you need to master these 3 pillars. Without them, it's like building a house without a foundation. The first pillar, the power of compound interest. This concept is so important that I dedicate a moment to it. Compound interest is the 8th wonder of the world. It occurs when your money earns interest, and that interest, in turn, also earns interest. It sounds simple, but the long-term effect is incredible. Imagine this. If you invest $1,000 today at an annual rate of 10%, in 1 year, you'll have $1,100. And the following year, that 10% isn't calculated on 1,000, but on 1,100. Your interest is generating more interest. If you invest $200 a month for 20 years, you can accumulate hundreds of thousands of dollars, and most of it won't come from the money you put in, but from the growth of that compound interest. Time is your greatest ally. Starting today with a small amount is more powerful than starting in 5 years with a large amount. The second pillar, diversification. Diversification is your protection. It's the concept of not putting all your eggs in one basket. If that basket falls, you lose everything. Instead, if you spread your eggs across several baskets, if one breaks, the others remain safe. In the world of investments, diversifying means investing in different types of assets, stocks, bonds, real estate, and in different sectors: technology, healthcare, energy. This way, if one sector or country is not performing well, the rest of your portfolio can compensate for it. Diversification reduces your risk and helps you sleep peacefully. The third pillar, risk in your profile. The golden rule of finance is: the higher the risk, the greater the potential return. And the lower the risk, the lower the return. There are no shortcuts. It is essential that you know yourself and understand your risk tolerance. There are 3 profiles: the conservative, the moderate, and the aggressive. The conservative investor seeks security, even if it means earning little. They put their money into things like bonds or high-yield savings accounts. The moderate seeks a balance. They invest in solid stocks and bonds. And the aggressive, like me, is willing to take on more risk for the possibility of a higher return. They invest in individual high-growth stocks, for example. There is no good or bad profile. Yours is the right one, as long as you sleep peacefully at night. 3. Practical first steps to investing. You already understand the theory. Now, how do you get started? This is what you need to do before investing a single dollar. Step 1. Define your goals. Why do you want to invest? To buy a car in 5 years? For your retirement in 30 years? Your goal will determine your strategy. If it's a short-term goal, you need something low risk. If it's long-term, you can take a bit more risk. Don't invest if you don't have a clear purpose. Step 2. Build the foundation, emergency fund, and debts. Before investing, you need an emergency cushion covering 3 to 6 months of your basic expenses. This fund is untouchable. It's your insurance against life. And of course, eliminate all high-interest debt like credit cards. It doesn't make sense to invest to earn 8% if you're paying 25% interest on your debt. Step 3. Open an investment account, the broker. You need an account to start investing. Brokers are platforms or companies that allow you to buy and sell financial assets. Research which one is the most reliable and secure in your country, has low commissions, and is regulated. Don't go for the broker that offers you a big bonus. Choose the one that gives you trust and security. 4. Types of investments, your winning portfolio. Now, yes, what everyone wants to know, where should I put my money? I will give you the options from the simplest to the most complex. 1. Index funds, ETFs, the option for beginners. If you know nothing and want to start right now, ETFs are your best friend. As I mentioned, they are a fund that automatically invests in a group of companies. For example, the SPY is an ETF that replicates the S&P 500, which consists of the 500 largest companies in the United States. It's like buying a little piece of all of them at once. It is low-cost, diversified, and does not require you to pick each stock. For a beginner, it is the best way to start and to profit from the market. 2. Individual stocks, the next level. This is buying a piece of a single company like Google, Apple, Coca-Cola. Here you do need to research, know what you're doing, and believe in the business. It is riskier than an ETF, but if you choose well, the potential return is much higher. This is the path for those who like to analyze companies and believe in a long-term vision. 3. Real estate. A classic. You can invest by buying an apartment to rent out or through REITs, which are like real estate ETFs. Historically, it is a very safe investment that provides a monthly income and appreciates over time. The problem is that it requires a very large initial investment and is less liquid. 4. Cryptocurrencies. The world of high volatility. This is a new, exciting, and highly volatile market. The potential for profit is very high, but the risk of losing everything is also significant. If you're going to invest here, do so with an amount of money you're willing to lose, and only after you have solid foundations in your other investments. It's not for most people. 5. The mindset of a successful investor and the next step. Finally, I want to talk to you about the most important thing, mindset. A successful investor is not the one with the most money. It's the one with the best discipline. Patience is your greatest virtue. The market goes up and down. There will be moments of fear, but a true investor does not sell in panic. They stay steady and think long-term. Automate your investments. The best investor is not the one who knows the most, but the one who is most disciplined. The best way to be disciplined is by automating the process. If you wait until you have extra money at the end of the month to invest, I promise you will never have extra. The trick is that as soon as you receive your salary, a portion is automatically transferred to your investment account. The rule of regular investment or dollar cost averaging. It is investing a little money regularly, regardless of whether the market is high or low. When the market is low, you buy more. When it is high, you buy less. This removes emotion from the process and ensures you get a good average price over time. Look, investing is not a magic trick. It is a process. It requires discipline, patience, and continuous education. The most important thing is not starting with a lot of money, but starting now. Time is your greatest ally. Don't leave your money in the bank losing value. Make it work for you. And it's not about getting rich overnight. It's about building a solid financial future for you and your family. So the next step is to choose one of these options, do a little more research, and take the first step. The future of work is from home, but the future of money is through investments. If this video helped you see the world of investments more clearly, give it a like, share it, and subscribe so you don't miss the next video. See you.